Hello, everyone. My name is Richard Leggett, and I'm the CEO of FrontierView. On behalf of my colleagues at FrontierView, we welcome you and thank you for joining the first episode of our new GlobalView series. We're very excited about this new offering for FrontierView clients and can't wait to share it with you. The idea for GlobalView was born out of the many vibrant discussions and debates that we have internally as part of our proprietary research process. Each month, we will aim to bring you a summary of the large-scale global macroeconomic trends that our teams monitor and that we feel you and your team should be tracking. We will provide you with our view on these trends and share their direct implications for multinationals. Each month, we will also spotlight a special focus topic at the end of the session. Given that we average around 200 client conversations each month, we will choose the spotlight topic based on trending topics or frequently asked questions from those conversations. Our format for GlobalView is a fireside chat discussion format that I will moderate along with Ryan Connelly, FrontierView's Chief Global Economist. Our special guest for today's session is Alejandro Valerio, FrontierView's Associate Practice Leader for Mexico, as we will be spotlighting a deep dive into Mexico given the interesting cross-current forces taking place right now with the strong US recovery, Mexico's midterm elections approaching, and spiking COVID trends in the country. As we get underway, I encourage you to log into GoToWebinar to view the materials that we will present today. And as a reminder, you are welcome to submit questions by typing them into the chat box on the left-hand side of your screen. Our client services team will be sure to follow up with you after the session. One last introductory point. Since GlobalView is a brand new addition to your FrontierView program experience and is intended for you, our clients, we very much welcome your feedback so that we can shape the discussion and format to best suit your needs. Now, before we start the program, we realize that some of you may be newer to FrontierView, so I'd like to take a moment to provide you with a quick overview of our firm and how we support multinational executives. FrontierView is a global market intelligence and advisory firm. Our tagline is Market Intelligence Built for Business. What does that really mean? It means that every aspect of FrontierView, our research, our data, our tools, our user experience, our high-touch analyst advisory support, and our client executive network has been purpose-built to focus on serving the market intelligence needs of a global business professional at multinational corporations. Our clients rely on us as their trusted market intelligence partner to help inform and power their ongoing market monitoring, annual and long-term strategic planning processes, and international growth strategies. We are incredibly proud of our client base, which today includes a community of over 3,600 professionals across more than 250 leading companies and is growing every day. As valued clients, I would like to also remind you that you have access to our mobile application, FrontierView Mobile, where you can see all of the relevant content you need to monitor markets, including this session's recording and presentation deck. Feel free to take a moment to use the QR codes on the screen to download the app from your relevant app store. And now I would like to take a moment to introduce today's presenters. As I mentioned, I'm joined today by two members of our global research team. First is Ryan Connelly. Ryan is our Chief Global Economist at FrontierView. He and I will be hosting GlobalView each and every month. Hey, Ryan, welcome.
Hey, Rich, thank you. Excited to be here.
After many months of planning, I'm so excited for this first GlobalView episode. And our second panelist today is Alejandro Valerio, known internally as the Professor. Alejandro is a senior member of our Latin America research team, and he leads our coverage on all things Mexico, and he's recently launched our MexicoView Executive Network together with our partner, the media company Mexico Business Publishing. Alejandro, welcome.
Thank you, Rich. It's a pleasure to be with you and with Ryan. Excited with this new launch.
Well, let's get started. Alejandro, we'll come back to you in a little bit, but in terms of agenda, I want to first cover some of the big macro global trends, and then we'll dive deeper into Mexico. Does that sound good?
All right. Sounds good to me.
Okay, good. Well, Ryan, let's start with a quick summary of the key themes that we've been tracking for the last month, and maybe just an update for our audience on how they've played out.
Great, thank you, Rich. So as Rich mentioned at the beginning, this grew out of a part of our own internal forecasting process that we conduct every month with our internal research team. In the last month, we've really been looking at sort of three major themes that define what we were looking at in April. One was this risk of new waves of COVID-19 outbreaks that were set to occur across emerging markets. And rather unfortunately, we have seen significant widespread outbreaks in India, Chile, and Thailand, as well as a few other countries in the world. That's led to some impact on our medium-term forecast outlook. Second will be oil prices, which have continued to surge. We did expect OPEC Plus to take some steps to stem global oil price growth amid the surge in prices we've seen recently, and OPEC did come out and announce an additional 600 million barrels per day of capacity for May. And then finally, the rapid vaccination trends across developed markets, where we expected the US to continue its rapid pace of vaccination, as well as a pickup of vaccination in other developed markets in Western Europe and Canada in particular. And as we'll see in this presentation, those were borne out in the month of April.
Ryan, when you look ahead for the next 30 days, what are the kind of the key global themes that you're telling clients to be paying closest attention to, and why are they important?
So for this month's theme, we're going to see this borne out in some of the data points that we have as key questions. One of the first things is this continued sort of recovery in developed markets, especially relative to emerging markets in vaccination reopening trends, which really defines sort of the business outlook for the second half of this year for many companies. The second real point is that we expect a little bit of US dollar weakness to persist against your major developed market currencies, Euro, GBP in particular, as the European outlook starts to improve due to its onset of more rapid vaccinations. And that's going to improve the growth outlook as well as the currency outlook for the euro. But we do continue to expect that EM currencies will depreciate against both the euro, British pound, and the dollar due to the ongoing weakness we're seeing in major economies in the EM space. And then finally, we're seeing this sort of recovery in production and consumer demand. We expect that to remain positive and see ongoing output growth pressures that leads to continued price increases in commodity prices and continued logistic demand hurdles.
All right, we'll dig into all of those, but the number one issue, I think, just to start and table set a little bit, the number one issue on the minds of our clients around the world is when do things really return to normal, and what does normal look like? And I thought to answer this COVID recovery question, we have to do some context setting regarding vaccine rollout. So where do we stand right now across major markets?
Yeah, so we're starting to see impressive pickup in vaccination growth rates across, as we mentioned, a lot of your sort of core developed markets. So the United States has sort of seen a rapid growth in vaccinations since the Biden administration. Currently around 70 million, about 70, so this is vaccines per 100 people. So in the US, there's about 70 vaccines administered per 100 people. Now, many of these vaccines are 2-dose vaccines, and so you're going to actually have to see closer to 200 doses per 100 people for full vaccination coverage, depending on the blend of J&J versus other vaccine types. But as you can see in the data, this is the weekly data for the last 4 weeks. Look at the impressive upticks in Canada, UK, Germany, France, Italy. Those administration rates had been lagging, and now it's really picking up in an impressive way. And so that's very positive for the markets. Across a lot of the rest of the emerging world, what you can see is quite a few markets, Poland, Russia, Turkey, India, China, Mexico, Brazil, still have quite low vaccination rates. And that is due to both distribution issues, but also lack of supply for vaccines. In the case of Chile, impressive vaccine growth rates, but that's actually a lot of single-dose administrations of the Sinovac vaccine, which they got access to, which hasn't been nearly as effective as some of the other vaccines. And that's partly explains why we're seeing such a big uptake in COVID case counts in Chile, despite the high levels of vaccine administration.
Ryan, India is clearly experiencing just an extraordinary spike in COVID. And from our discussions with our clients and contacts on the ground and also our colleagues, it seems that actual conditions are far worse than what's being reported. And what's being reported is just tragic to even think about. And first, I just want to say our thoughts and prayers go out to our clients and our many colleagues in the company that have family in India, as well as to the frontline workers. When you think about India in particular, what is our latest thinking on when we'll see conditions stabilize and improve, given just the humanitarian crisis we're seeing there?
Yeah. So the good news is because of the rapid rate of COVID case counts, because of issues of hospital capacity and the broad awareness of the crisis, we do expect that a combination of state-level restrictions in India, as well as individual behavioral change within India, is going to start to lead to a reduction in case spread within the next 2 weeks. And so we should start to see case counts start to decrease over the next 2 weeks. They will remain elevated for some time. And so sort of the sort of May outlook is hopefully case counts that curve starts to flatten back down. So we're really back in a full lockdown mode. That's going to lead to, reduced expectations for the second half growth in India, as was going to trickle over into 2022 as well. The US did announce that it would start to release some additional support for India. It really just sort of highlights the fact that even though the US is feeling so much better, the COVID crisis is not over, and these risks of widespread secondary outbreaks will continue. It's just very problematic when it's such a large, densely packed country like India, and we're seeing that play out right now.
Yeah, it's just tragic. So we'll keep a close eye on that. I want to shift, if we could, to one set of major indicators that you track regularly, and it's an important set. It's the yield curve, and here we've seen a steepening since the start of the year. And I guess what are the current yield curves telling you about monetary policy and future growth expectations across the various major markets as a starting point?
Yeah. So there's two important things that I want to highlight on the yield curve right now. The first one is that central banks are keeping the front end of the yield curve, so your short-term rates, really pinned at that zero or even negative rates in the case of the Eurozone. Central banks have not moved on their language that they expect to maintain rates low, even despite some concerns of some temporary higher inflation this year. We'll talk about inflationary pressures later on this call. Where we've seen most of the movement is going to be there on the back end. So on the 30-year rate side, you can see in the US, back-end rates have increased by between 50 and 75 basis points for the US, depending on the exact indicator. They've increased for the UK as well. They've also increased for Germany down there at the bottom. That bottom line has shifted up into positive territory this year. And what that's telling you is that markets are not so worried about long-term deflation and long-term recession as a result of this crisis, and that the sort of outlook has gotten a bit more optimistic for the recovery. And you can really sort of identify where that gap starts to increase if you look at the dotted blue line for the US, for example, the low line versus the higher lines. It's really around the 2 to 3 year range where sort of interest rates have really started to improve in the US. Similar story with the UK, and we expect that sort of reflation optimism will continue to sort of drive markets higher throughout this year.
So those are positive indicators in your mind about growth. Okay, good. So let's think about long-term rates for a second. Here we've seen kind of yield curves largely unchanged in developed markets recently, but developing markets, we've seen a different story. Maybe you can kind of shed some light on that.
Yeah. So one thing that you sort of just alluded to is this about are long-term rates rising because of long-term inflationary concerns, or are long-term rates rising because of a more positive growth outlook? Looking across the board here, this is sort of just the change in 10-year rates in the last month. You're not seeing any sort of universal push towards higher rates in the last month. The sort of things that inflationary concerns would suggest, right, would be broad global movements higher. What you're seeing in the last month is 10-year rates are basically stable. We saw it in the yield curves too. They backed up a little bit. And all you're really seeing is a few problem child countries where you've had a dramatic change in the last month in 10-year rates. Turkey and Nigeria, both are due to a combination of inflationary concerns, FX concerns, and credit concerns, as well as Chile down there on the bottom right, which had a pretty significant jump in the last month as it entered a second lockdown, had its debt downgraded in March, and there are some fiscal concerns. So not a lot of movements in the last month besides those problem cases.
Do you see in those specific problem cases of Turkey, Chile, and Nigeria, do you see them as a short-term issue, or do you see it persisting? And if you put your client hat on, what are the implications that clients that operate in these particular markets should be thinking about?
For Turkey, it's been an issue for 2 years, and so it's an ongoing issue of trends in the market of rising credit being pushed out by the government, which has created the space for FX depreciation as well as domestic inflation from local drivers as well as import inflation. Those are issues that are here to stay for Turkey. Nigeria, you're starting to see that same exact sort of dynamic start to play out with concerns about FX depreciation emerging more. In the case of Chile, it's a little bit more, there's some political questions in the short term about what's going to happen with the fiscal space in the constitution. But Chile has enough excess capacity that it's not going to be a meltdown scenario like Turkey and Nigeria unless some very significant political changes are made.
Okay. I want to dig into inflation in some greater detail in a moment, but while we're on the topic of rates, at a high level, there's so much press about inflation, and how big of a threat is inflation in your view, and how does it vary across developed versus developing markets?
So inflation is definitely a risk for the next year or two, and I think that there's multiple sources of inflation we're going to have to sort through for the rest of the year. As we saw in the last chart, and as we're going to sort of see in this chart, one of the major causes of concern for inflation this year is going to be ongoing FX depreciation of emerging market currencies against developed market currencies. And that's because of import inflation for the kinds of consumer products that firms and households tend to import into emerging markets. So looking at the last month in the change over the month-over-month exchange rate on the right side there, you can see pretty broad-based depreciation of major EM currencies to the US dollar. In a lot of cases, in the case of Brazil in particular, we've already seen that start to play out in terms of domestic inflationary pressures. Overall, in the last month, though, the euro to US dollar has been pretty stable. The US dollar gave up a few of the gains that it's been sort of accumulating the last few months. And so again, to reiterate one of our key themes looking forward, we do think that there'll be a little bit more US dollar weakness to major developed market currencies, but we actually expect the EM currencies to continue to show some weakness over the next few months, just due to weak growth prospects, ongoing issues with COVID control, slow vaccination rollouts, and the like.
Okay. Let's shift to manufacturing, because another big indicator that we watch globally is manufacturing PMIs. And here we've also seen this kind of storyline play out of this bifurcation between developed and developing markets. And in particular, we've seen a little bit of a slowdown in China. So when we think about all of that together, how should clients interpret the PMI story or the story that the data is telling, and be best prepared going forward? And especially with this kind of slight decline taking place in China, is that the beginning of a trend, or is it just kind of a bit of a slowdown off of what has been a robust period?
Yeah. So the PMI data we have here this is January through March of this year. Anything above 50 means the average manufacturing firm is seeing as an expansion of orders from the previous month. You can see across, especially the left side of the developed markets, strong sequential growth month over month. And in many cases, this is a sequential growth for the last 12 to 14 months since bottoming in April. So developed markets still see pretty strong demand. We've all heard issues of inventory issues, lack of product availability. And in the case of the US, we actually saw that inventories depleted quite substantially in the first quarter, which actually means that you're going to need to increase production to rebuild some of those inventories going forward. So we see that strong demand really being here to stay for a little bit. Eventually, we're going to see a return to normalization, right? As people get back into a more normal post-COVID environment. They've already pre-bought a lot of their sort of consumer durables, and we'll see a shift of that manufacturing cycle towards slower but sustainable growth. Looking at the emerging markets, the picture is a bit different, especially with China. You can sort of see their PMIs have started to weaken. This is continuing a trend for a while. The government started to pull back some of that fiscal and credit stimulus that they really put on thick in the first and second quarter of 2020. We're hearing some concerns that they might want to start to address issues of the property price inflation again by trying to make sure a bubble's not forming. And that just puts some sort of pressure on the rest of the emerging market complex, especially commodity exporters who heavily rely upon those inbound commodity exports to China to lift them out of a slow growth cycle. So a little bit of bifurcation there, as you can see, but we do think the developed market trends are probably strong, and we're seeing still positive growth in most of the emerging market space in the PMIs.
And I see our friend Mexico there is below the line, and we'll get to that with Alejandro shortly. So
that's right.
Back to inflation, I want to shift over to producer PPI. Basically, we've seen the demand for manufactured goods driving up producer prices and also the price of commodities. So inflation is clearly present on this side of the ledger. What is your outlook as we look forward in terms of pricing for inputs and manufactured goods?
Yeah, so commodity prices on the left side, and you can even include like logistics and some of the supply cost issues that we're seeing on the logistics and shipping side. This has been a very weird recession in the sense that back in the first quarter of 2020, in the second quarter, you saw temporary drops in oil, but you didn't see strong drops in cyclical commodities. And that's because of the particulars of the COVID cycle. We've seen rapid growth in prices for all those products, and we think that's a combination of very strong demand, especially for consumer durables, against a constrained supply environment where you've had lack of investment, you've had mining shortfalls due to lack of labor, you've had strikes, you also had a lack of investment into mining that was overdue to happen. So we actually see some of the supply picture alleviating towards the back half of this year as that excess demand for consumer durables in particular will start to slow. And we see some, some normalcy in the mining cycles that allow for a little bit of inventory rebuilds to happen. So we do think price pressures are here for the summer months, but will probably start to abate in the third and the fourth quarter. In terms of the producer prices, obviously input prices are significant, and you can see that especially in the US, where you've had strong sequential growth for the last 3 months, basically, in producer prices. And that's a very clear sign of the kinds of costs that producers are facing. And they're looking for ways to pass those costs on to final consumers, which could lead to some temporary consumer price inflation. In the case of places like Russia and Brazil, that's being distorted heavily by exchange rate depreciations, which is obviously doubling up the increase of commodity costs.
Yeah, I was going to ask that question because you clearly, if you look at the chart on the right-hand side, there's certain markets that have, that are outliers, and that is a function of both higher pricing and FX exposure. I guess, how persistent will that be for Russia and Brazil in terms of, these are big markets for many of our clients, and so how long do you see that lasting, and how should clients best position themselves to mitigate that risk?
For most emerging markets in our forecast portfolio, we expect that the weakness that we're seeing right now is not going, basically that currencies will end the year stronger against the dollar than they are right now. So we're sort of at peak week levels in some cases. So we do see some of that alleviating. In the case of Brazil in particular, we expect a little bit of recovery. But I think that really looking through that, I mean, you'll get some alleviation on the inflation side from the currency, but if you just look across the US, the UK, what's happening in Japan, especially there, what's happening in China, this producer price story are globally traded goods, and it's having an equal pressure across markets. So I think that's really the underlying story we have to focus on, and the exchange rate issues are just compounding factors in some of those large emerging markets.
Okay, let's turn our attention now to the consumer side of the story, and let's start with consumer confidence, which is obviously an important measure that you look at regularly. And again, here I think we see also a slightly different story between developed and developing markets. What's the data telling you?
Yeah, it's again, you can see what's happening with the ongoing rate of vaccination trends and falling case counts in Western Europe, the US, and other large developed markets, leading to an increasingly optimistic environment. And so there's a little bit of noise in some of this data, but looking at sort of the quarterly data here, you can see what happened basically in the last sort of 3 months. Very strong upwards confidence in the March data that we saw, and I expect that to continue to improve in the April data and beyond as vaccination leads to reopening and return to normalcy. For markets like the US, we basically expect full normalcy by the end of the summer, and for Western Europe, similar, maybe a month or two delayed. It's on the EM side where you can see much noisier, harder to cite like a specific trend. And as we're seeing with India in particular, you're going to see backups in confidence. And that's also borne out by that Chile data, which turned negative right before they sort of implemented their new lockdown in April.
So the storyline is vaccine rollout leads to higher consumer confidence, which then probably leads to our next topic, which is looking at retail sales as a measure of whether consumer confidence is actually translating into consumer behavior. What are you seeing there in terms of retail sales trends?
Yeah, so the problem here is that, as we talked about right there, COVID is really driving a lot of the confidence data, but that's also being driven by, in last year, some of the fiscal support the governments were passing. Now with emerging markets, the real challenge is that you're having rising COVID cases in many areas, you're having slow vaccinations, and as we'll see in Mexico too, you don't have as much fiscal spend projected going forward. And so it creates a real issue, especially for consumer confidence data spilling over into potentially weaker sales in 2021 due to lack of fiscal impetus and depleted savings rates. This retail sales data is still quite noisy. So looking at it year over year, which are the sort of orange dots, you can see most markets are positive, right, year over year from March to March. So you see that particularly in the US and all the developed markets are sort of slightly positive. In EMs, you've got some very positive cases like Poland and China and even Chile, and then some people that are weaker or even slightly negative. The monthly data, you can start to see in March that acceleration that we're expecting in the US in particular, as well as in the UK. And we think that the ongoing vaccination trends will start to turn that data positive for the Euro area as well. And again, for EMs, it's just very, very noisy what we're seeing. And that's because the particular experiences in each country are so distinct that it really requires that sort of country level market monitoring and forecasting type approach.
So putting your client hat on for a second, thinking about that, where would you place your bets on continued or improving both consumer confidence and retail sales for the balance of the year if you were kind of portfolio managing this as a client?
Yeah, I mean, I think that the real place you're going to see the most successful growth is going to be areas in Western Europe, particularly for once, some areas like Spain and Italy, where you're finally going to get that inbound tourism from the rest of the Euro area as vaccinations allow people to take leisure travel. And I think that'll be sort of the bright side in that portfolio.
Okay, let's go with just one more on the consumer, which is, with demand on the rise, higher producer prices, we've seen consumer prices rising as well, along with monthly inflation across nearly all markets. And again, I think there's been some bifurcation between developed and developing markets. So what is the story the CPI data is telling you, and what this means in terms of your outlook? You mentioned that inflation might be kind of more of a temporary phenomenon on the manufacturing side, but what about on the consumer side?
So you do see a bifurcation here between basically emerging developed markets where inflation is in some cases rising a bit above central bank targets, like in the case of the US and Canada, it's a little bit above 2.5%, which is mostly what they'll target for CPI, though it's not actually what they target officially, versus emerging markets where, with some exceptions like China and Thailand, you're seeing quite significant inflation. You're also seeing the monthly inflation trends pick up, and that's similar to what we're seeing in PPIs, right? Some of these are tradable goods that are leading to inflationary pass-through across markets. Off to the right there, you have two problem children sort of haven off, and you can see there the CPI impacts year over year. I'd say our outlook here is that we have increased our inflation forecast for this year across most countries in the last 2 months, because we're starting to see these underlying price dynamics work their way through the system. Our clients are asking us client questions about pricing all the time, so we know that clients are looking for ways to increase prices to preserve and even increase margin. But we think that for developed markets, this is transitory. Euro area inflation, Japanese inflation is still above where the central banks want it to be, so they're going to keep up stimulus. In the case of the US, we do think you'll see a little bit of wage inflation, but that's not a bad thing. We don't see a wage spiral. We see temporary wage inflation to coax workers back into the labor force to chase some of those higher wages. In emerging markets, you can see quite higher inflation. Again, you have a compounding issue here of a lot of EMFX depreciation so far this year, rising producer prices that are feeding into the input cycle, as well as a lot of central banks that are, and sort of domestic policies that are increasing credit provided to the economy in ways that's basically debasing the internal value of the currency. So again, it's one of those sort of market by market, how concerned we are about sticky inflation versus transient inflation. But in general, I think that the inflationary pressures we're seeing in EMs and in developed markets are probably going to keep rising a bit for the next few months.
So just last quick question on this, and we can be quick, but just based on that, if it's going to persist for a bit of time, will we see change in consumer behavior, either a slowdown in spending or maybe trading down in terms of categories? Like what do you see happening there? Because clients need to prepare for that.
Yeah. So in developed markets, I'm not very concerned about client behavior from moderate price increases. What I am worried about in emerging markets in particular is that in a lot of these countries where we're seeing higher inflation or FX pressures or both, the response that governments are taking is to slow down the economy, right? Either by hiking interest rates or reducing fiscal spending or slowing credit growth or taking steps like in China to try to both slow credit growth but also to attack certain what they think might be speculative bubbles. That's a very bad combination, because what you're going to see there is rising inflation is so problematic that you could see some consumers trading down, just as the government's taking steps to slow growth, which will actually hit the real income of those sort of lower income and affected households as well. So I do think in a lot of emerging markets, there's that sort of story of inflation triggers policy change, which could actually trigger reduction in aggregate buying by some of those consumers.
Okay, that's something we're going to watch closely in our upcoming episodes, I think. Really quickly, and I want to shift over to Alejandro in Mexico, but let's just take a quick look at the global equity markets. And here we're really just trying to understand are we seeing any red flags? We've seen great performance mostly in outside of Asia and maybe Turkey in the last month in equity markets. But what are you seeing any red flags that the equity markets are calling out?
The short answer is no. So we don't maintain a view on whether these valuations are fair, right? So we're not making a judgment on PDE ratios or forward earning by companies. We have seen forward earnings by companies go up substantially. They're now stabilizing after we're past the COVID shock. We watch equity markets to see, is there going to be a massive change that leads to a shift in investment or a shift in consumer confidence? And we haven't seen that. In the past month, you've had most equity indicators up slightly, some down a bit. Year to date, every major equity market is up. The 3 to watch here, or 4 to watch, is going to be obviously what's happening in Turkey and Brazil. We've had inflationary increases. We've had problems with the exchange rates. That's leading to a decline in those asset prices, which could lead to a further change from the policy side of government to tighten policy, or a lack of consumer confidence and consumer spend. We're seeing that in China as well. And then India obviously is going to be very interesting to watch the Indian equity market indices this month.
Yeah, given the performance versus the story on the ground there, we'll keep an eye on that. All right, thanks, Ryan. Let's now, if we could, together welcome our guest Alejandro into the discussion to speak about Mexico. And we chose to spotlight Mexico this month based on many client conversations and questions that we're getting right now about Mexico. And it's really fascinating because we know Mexico is closely tied to the US economic recovery, which we see as quite strong. But at the same time, we have a spike in COVID in the country. We have upcoming midterm elections in June, which are creating a little bit of uncertainty. And of course, there's a crisis over at the border. So with that, Alejandro, welcome, and we hope you'll help us unpack all of this in the next few minutes. Maybe, Alejandro, let's start with context setting in terms of COVID. Mexico has become one of the worst hit countries in Latin America. What's happened, and what is your outlook as to when the situation improves and when Mexico can reach herd immunity?
Yep. Thank you, Rich. Well, the first thing is actually, we can see in the case of Mexico, like what happened to also in Brazil, that you have policy matters, and actually coming from the head of state actually matters. Like at the beginning in Mexico, were downplaying, and then there were divergence in terms of actually what the federal government was doing and then what the state government were doing. That's more and less, yeah. It's good to remember too that AMLO had a really good relationship with President Trump. But that said, Rich, to the point now, it's actually what you can see here in this chart. It's that actually Mexico indeed has been one of the worst hit countries in Latin America. It's like more than 250,000 death toll and counting. And even though that the pandemic actually has improved in terms of control or has been abating in March, I would say that Mexico is not out of the wood, because Mexico is still quite low in terms of the vaccine rollout. At this point, as we speak, only close to 5% of the population has been fully vaccinated, which is actually way below of what the government is actually expecting to have, like to reach herd immunity 70% by July, August of this year.
That seems like a steep curve. We've also, in other countries, we've seen strong response from governments in terms of stimulus. But in Mexico, we've seen little support from the government. Why is this?
It comes down, I would say, that with the personal choice from the president. President López Obrador, he assimilates any financial lifeline to the business sector has corruption. And it's good to remember, go back to history, what happened after the 1995 crisis, the tequila crisis. There were a financial lifeline to the banking sector, that there were some corruption allegations, where this president actually, he made a career about denouncing that financial lifeline. And I think that has been the main reason why the federal government hasn't provided any financial stimulus to the business sector. That since last year, reached maybe close to 1 million small and medium-sized business in Mexico has actually gone down because of the lack of stimulus. However, as we can see here, Mexico has been blessed by the remittance inflows coming from the US. Just last year, it was actually 40 billion that Mexico received, close to 5% of GDP. And this trend is going to continue when we see the great numbers in Q1 that Mexico received a record setting. It was actually an increase more than 13% on an annual basis in Q1, including in March, where it was close to $4 billion, 10% year-on-year increase. That has been, I would say, the cushion in front of the lack of government stimulus from the government.
But Alejandro, do you see the government doing anything to provide some stimulus to build up on the remittance story?
No, Rich, and I want to be blunt on that. I think the government is going to be focusing on bankrolling the social programs and financing some key projects like the Maya train and oil infrastructure.
Okay, and we talk about at least for now there are midterm elections that are slated for June 6th, I believe. What are the key policy initiatives you're tracking, and how should our clients kind of make sense of this and prepare themselves?
Good. On June 6th, it's a consequential elections. The Chamber of Deputies is going to be out for grab, and then also the gubernatorial elections too. So these are actually what you can see here in this graph. What are the key initiatives of the government? Some of them, they've been knocked down because of the pressure, like the legislation to change the central bank autonomy. But if the government actually wins or retain the absolute majority in the Chamber of Deputies, we shouldn't rule out that actually that type of legislation is going to come back to the plate. However, I will point out two key reforms, Rich. On the one hand, I'm tracking the energy reform. I mean, President Lopez Obrador, he has a clear plan to revamp state-owned owners enterprise like Pemex and the Federal Electricity Commission, and then another reform that I've been telling to clients the last 5-6 months that might happen is actually tax reform, and it's because government revenue has been decreasing and the government has been relying more on non-oil revenues. And in that case, if revenues continue to go down, a tax reform should be expected as soon as after the election on June 6th, contingent if the government wins or retain the absolute majority in the Chamber of Deputies.
So Alejandro, what does that really mean in terms of growth in the short and medium term growth outlook for Mexico? Because higher taxes, more and lack of stimulus feels like it's going to take a while for different sectors to recover, maybe longer than our clients are expecting. And so kind of talk us through that recovery trajectory, timing, and just your general growth outlook.
Sure. First of all, I mean, we expect in Mexico to grow like around maybe 4.1% this year from a really low base of historical contraction of last year, 8.5%. But then I would say that we need to think about Mexico in a K-shaped recovery. And this is actually what we can see here on a quarterly basis, how different segments are going to be performing. And in a nutshell, Rich, all the sectors that actually are linkage to the US business cycle, they're going to be performing much better. Or segments that actually rely heavily, I would say, on government spending on the infrastructure, on the electricity sector and the oil sector for that matter. But I will point out here the following, like I'm more hopeful, for example, in terms of manufacturing, particularly like auto parts, considering that actually household spending in the US is going in a good trajectory. And in Q2 and Q3, they're going to go up again too, especially auto sales. And I feel more hopeful when we think about, for example, the IT and telecom companies, because as I was pointing out before, since Mexico is not out of the wood in terms of the pandemic, companies and individuals alike are going to keep investing, trying to revamp their technological infrastructure.
So if you were to summarize all this, Alejandro, when do you actually see Mexico returning to pre-pandemic levels? You've kind of broken it out sector by sector, but overall, when do you see the country recovering? And just to put a marker on it, I believe the government says that they expect full recovery by the end of this year.
Sure. Yes, the government is expecting to be to pre-pandemic levels in 2021. I found that could be quite unlikely because I pointed out the main input of their growth projection is actually that Mexico would reach herd immunity by July, August, which is unlikely, as we saw that in that trend. My perception, and based on everything that we have seen, that is that Mexico is going to get to pre-pandemic levels, as we can see here in this chart, by 2023. That actually has to do because The weakest link right now in terms of GDP investment is going to be quite low in 2021. So we should be expecting a better outlook for investment rather in 2022 and 2023 and onwards. And as a consequence, we should be expecting also a slow employment recovery. Just to put you in a number, Rich, Mexico lost last year in the formal sector close to 700,000 jobs, and in the informal sector between 2.2, 2.4 million. And this year, I mean, they were expecting to add maybe 200,000 jobs in the formal sector, and they only added maybe 150, 160,000 jobs. Likewise, and Ryan already showed that we should be expecting low confidence levels in terms of consumer and business side too, which actually is going to have a take when we think about aggregate demand. And then just finally, on one hand, on the negative, the government is not going to provide a fiscal lifeline, even though Mexico has room to actually to provide it to the private sector. But when we think about the U-shaped recovery in external demand, Mexico exports and industry that are linked to the US business cycle, they should be benefiting, and we should be expecting exports to be back to pre-pandemic levels by Q1 of 2022. And that's going to help the economy moving forward.
Okay, all right. I think that's all we have time for, Alejandro, but it's really fascinating, and we'll have you back in a future episode to kind of catch up on what's been unfolding. Well, I think that's all we have time for today. That's our show for this month. Ryan and Alejandro, I want to thank you for the excellent and insightful discussion. And I want to thank our audience as well. We've covered a lot of ground in a short time, which is the idea of this show. If you've submitted any questions during today's discussion, we'll be sure to follow up with our responses through your client services manager. And you'll also receive a recording of today's show within 24 hours. Feel free to share it with your colleagues. And as a reminder, as FrontierView clients, you can schedule research briefings with Ryan, with Alejandro, or any member of our FrontierView global research team at any time by scheduling through your client services manager. And of course, all of FrontierView's research, award-winning data, and analyst insights are available and always updated on the Frontier desktop and mobile applications. This concludes today's GlobalView episode. We look forward to speaking with you again next month. Thank you and be well.